Okay, welcome everybody. Good afternoon or good morning, depending what part of the world you're in. I'm here in sunny Berlin, Germany with Jan Hurda to present this session, Risk Monitoring and the Evolution of GRC. We presented this a month ago at the ISACA conference in Munich, and we were asked to rerun it for a number of people who couldn't see it there, so if those include you, then this is for you. We're going to be presenting this. It's a 45-minute session. We hope to get it all done in 45 minutes as advertised. We are going to take questions at the end. We'll take as many as we can, and if we can't take them online, we'll deal with them by email afterwards. There is a question panel on your interface, the webcast interface, that you can use to submit questions as you go through, so please do so. And in the spirit of airlines, if in the event of any turbulence, the seatbelt lights will go on, and the emergency exits are here, here, and here. So you now have all of the important information. So my name is Dan French. I run a company called Consider Solutions, and I shall introduce Jan in a minute. So let's move on to the objectives of the session. So we want to look at the whole issue of risk monitoring and continuous controls monitoring and where it sits in the whole GRC landscape. This presentation is based on a case study for a very large organization based in Germany, where Jan has been running a significant program there. And a lot of the lessons learned there are consistent with what we've seen elsewhere, so Jan is going to share those with you. I'm going to talk a little bit about establishing automated controls based on risk and risk-based segregation of duties, share some of the best practice we've seen, but also how to refine the risk and control balance and see where this evolution is going in GRC based on this case study. So the agenda, I'm going to talk you through the starting points and just introduce some of the catalysts for the program. Then Jan is going to talk through the background and vision, the project approach, and how some of the challenges in controls definition optimization, the audit implications, and remediation. And then I'm going to come back and talk about some of the bigger issues around such GRC projects and some of the challenges and balance between segregation of duties and other forms of control from what we're seeing in terms of risk monitoring. And at the end, I'm going to pose what is quite an important question for you to consider. We can discuss that, and then we'll have questions. So just by way of introduction, so this whole issue of risk and compliance monitoring, we do that as well as do finance performance improvements, exception monitoring for these kind of companies. So just as a brief context, if those look like sort of companies you're in, then we're probably in the right place. So just talking about the starting point, the first point, whether we like it or not, is most, even today, most GRC initiatives, most risk monitoring initiatives seem to start with an audit finding. Now, there's a big question about whether that really should be the start of things, but it seems to be the catalyst to drive people to action. We're going to talk a little bit about controls monitoring strategy and then introduce Jan in the compliance tool concept. So it's a very interesting question why it is that audit findings around financial controls, the most common finding is a weakness in segregation duties and user access. And it's an interesting question to work out why it is such a common finding, because you have to ask the question, is really this the biggest risk area that organizations face? Some emerging thinking on that. But this is a classic case. It's an extract from an audit letter, basically anonymous to protect the innocent. But you can see the comments made. Typical comments, we see that the comments are made here that the administration processes are inefficient manuals, lack of formally defined roles and responsibilities, very concerning comments about inappropriate access to combinations of critical transactions, which is segregation of duties. So as you see here, the recommendations. So we see this a lot, and I do keep coming back to the question, why is it the audit finding really tackles SODs as such a common and primary finding? We'll come back to that at the end, because I think there's some lessons we can learn from that. So COSO and COVID have a very good schematic framework, which I like, and it's represented here, which kind of illustrates the relationship of the controls monitoring that one performs through GRC projects and programs, and obviously monitoring IT general controls and application controls in applications that are financially relevant. You see that in the middle. And the relationship of those to the business processes and the classes of transactions that they support, and how they relate to the significant accounts in the financial statement. Because fundamentally, this is mostly about trying to assure the financial statements are correct and there's opportunities for misstatements and fraud and error is eliminated or reduced. So I like that diagram. I like also the definition of the 4 pillars of continuous controls monitoring, which I tend to regard generally as just continuous monitoring because they aren't all necessarily controls. But you see here these control layers were defined by Gartner Group, and I think it's a good piece of work they did. And you see here at the bottom of the stack, it's you know, technology configuration of systems and processes at a detail level. Do our systems allow people to do unusual administrative tasks? The next layer is access to applications, so it's a segregation of duties, sensitive access. Can people do A and B? Can they create vendors, pay invoices, and so on? But then moving up, we're also looking at managing risk associated with master data. Is the underlying data accurate and controlled? Are changes happening to it at unusual times? Are they appropriate? Are they appropriately authorized? And at the top, we see the whole transactional monitoring about what is actually going on and what are the exceptions happening in our business at a detailed process level. Now that's an important diagram because, as we all know, most of these continuous monitoring GRC projects seem to start with SOD, but it's quite low down the stack of importance in terms of key risks to monitor and how close they are to reality. Because of course, segregation of duties is a kind of a theoretical risk rather than an actual risk. So we're going to see more about that in a minute. So as I lead into Jan's talk, in this particular case, again, they started with a similar comment from audit about their concerns over access control to major systems of financial interest. And so there was a general review of access control strategy for all of their applications. And if you go around from the top, from the 12 o'clock point here, obviously that's about establishing policies for SOD and sensitive access, so identifying and analyzing possible threats to those SOD policies, remediating those, establishing compensating controls or mitigating controls where critical, and then analyze ongoing user access changes to prevent new risks, automate those change requests, and review that on a regular basis. So that's kind of the circle for access control. I'll now introduce you to Jan, who, as I say, has been leading this project in Germany and has a lot of experience working at Deutsche Telekom and at organizations with Consider around the world. Okay, Jan.
Thank you very much, Dan. Welcome to everybody. I would like to start with this small demonstration of a concept of how a continuous monitoring implementation can look like. Although this is the implementation itself might look differently, the components might change. In the end, it's going to be always the same. It's about data which needs to be analyzed, issues which have to be resolved, and some sort of process set up which prevents new issues of emerging. Before I dive into the detailed approach which was taken in our case study, I would like to guide you through the background and the vision and also the motivation, what was behind the start of this project. So in the beginning, it all started, as Dan said, in general terms, with an audit finding. This was the case also for this company. And the audit findings were the classical ones that in finance processes, there were users which were able to bypass the standard process, and eventually most of them didn't do it probably, and some of them, even when they did it because of trying to achieve the goals of the company and without any bad intention. In the end, it was a finding which the business acknowledged as a risk and which has to be solved. And at the beginning, they also thought that this is something what can be approached manually, which can be dealt with manually and on an ad hoc basis. This approach proves wrong. And if you ask yourself why this SOD or segregation of duties is such an issue and such a problem to solve in large organizations, well, the answer is probably the reasons for this are multiple, and all of them in the end come from the complexity in organizations nowadays, and also that this issue or segregation of duties as a topic is involving the business function as well as the IT function, and it's a topic which has to be addressed from functions across the organization. And the motivation of this project was to enable these people and these functions to deal with these issues and these conflicts. And a first step in enabling this was to increase the transparency. In the systems, and ultimately also achieve compliance with internal as well as external regulations. And the final vision was to be able to manage the risk, and as well as not just managing them at any cost, managing them ideally at a reasonable cost. As a secondary goal, let's say, there was the vision that ideally when this organization is in control of the risk, it should also achieve a clean sheet in any audit that it has to pass. And how they wanted to achieve this vision? Well, they defined that a way how to achieve this is to implement an automated tool to clean all their target system and ultimately stay also clean in the future. Okay, that's for the background and vision of this project. And now let's have a look on the detailed approach which was taken in order to achieve these goals. So in general, they have taken a work stream approach which defines the major areas in which have to be done in order to implement a continuous monitoring program. And I'm going to guide you through these streams in detail, but let me first introduce the streams itself. There is a work stream which is dealing with definition of what the risk for the organization is. There is also a work stream which enables the organization to handle the risks, to manage them, and in order to be able to analyze and to manage these risks, there has to be also an infrastructure set up and managed. And finally, when this all is implemented and set up, there has to be also the target system has to be cleaned, and also ultimately a preventive process has to be established in order the systems stay clean. And let me just briefly take you to one of the work streams, which is the establishing of processes and procedures. And the procedures and processes are established usually not in a vacuum. You have to define the right roles and responsibilities in your organization, and also implement them in the government structure of your organization. So there's a number of roles which have to be identified in order you can run such a project, and this was the case also in our case study. And there was a technical project manager who took care of the technical part of the project, and a business project manager. And there was a unit identified which was responsible for internal controls and internal control system, which were playing basically the arbiter of the definition of the risks and controls. And of course, for each of the systems, there was a group of business process owners and key users that were able to assess and define the solutions which should be taken. In the next two slides, there is an example how they have divided the roles and the responsibilities and tasks among themselves. This is not anything what's applicable to every organization. It's always has to be adjusted in order it fits in the current structure. But in the end, all the tasks which are listed in the next two slides should be somehow reflected in the processes around continuous monitoring. Which brings me to the processes itself. This is just a simple list of the very key processes. I don't want to go into detail of every and each of them. If you are interested to hear more or read more about them, we are happy to provide you with some nice best practice documents which would give you more insight into what the definition of these processes is and what's the current best practice. Which brings me to another work stream, which is probably one of the most important in a continuous monitoring program, and that is the definition of the risk itself. This part is basically the heart piece of every continuous monitoring implementation, because it defines what is the risk and what needs to be monitored in the organization. The risk and the structure of what should be monitored is going to be specific, and you can of course have different risks in different systems, depending on what processes are taking place in these systems. There is also organizational differences, so the risk might be different for a smaller part of the organization or a small company unit than for the headquarters or a shared service center. And also, when you are thinking about what is the definition of the risk, what's the control which could deal with these risks, and how you can tackle these if you can't simply remediate them. So when you are finished with the major work streams, meaning you have an infrastructure in place, you have your risks defined, you know how to manage them. You might also want to shift the focus of the auditor to your continuous monitoring program from looking into the detailed authorization information in the target systems. What I mean with that, an auditor approach is usually quite costly, and they are looking at an ad hoc basis into each of the target systems which are in scope based on materiality, and they are identifying threats to the organization. And if you can shift the focus from looking at laborious, detailed checks in target systems to having a consistent and complete continuous monitoring program in place, which ensures and assures that you are in control of authorizations in the system. This might bring additional benefits, and a way how to achieve it is that you prepare yourself for such an audit. And the main areas are also listed here, and we can provide you also with a checklist with detailed points. What is usually part of such an audit, which makes you more prepared for such an audit. And also from our experience, the best practice of avoiding audit findings is that you involve your auditor in the process of defining what the risk is, defining of the internal controls in your organization, and also that you have a clean change management process and audit trail which you can present to the auditor, along with an up-to-date documentation. This provides the auditor with enough assurance to certify your continuous monitoring program and shift the focus from bottom-up testing to looking at it from a top-down approach. And the last part which I would like to tackle is even when you have a continuous monitoring solution in place, you have your tool is there, you have a risk definition, you are monitoring your system. Usually, and that's our experience at the beginning, when you start monitoring, you realize that because of historic reasons and initial implementation, there is usually a lot of risks already present in your system, and you have to clean them. You have to look at the risks and ideally decrease to a reasonable amount of risk or exposure. And a zero would be a nice thing to achieve. However, in reality, this is not possible because in some cases you have to make a compromise of the freedom to get the job done and the ability to control the risk. And the way how you tackle the SOD conflict is basically that in most systems you have in most new modern system you have a role-based authorization concept. And first of all, you should make sure that the roles which you are provisioning to the users, which you are assigning the authorizations with, should be without an SOD conflict, should be clean roles and well-defined roles. This would be the first step in every cleanup, in every remediation, SOD remediation. And when you have a clean role set and you have a well-defined roles, you would still have a number of issues in your system given by users that have more than one role, and and are able to execute more than one task in the system, which might be perceived as a risk and as a possibility to bypass the standard process. The way how you can address these risks is that either you evaluate that in fact it's not such a risk, it might be a false positive, the risk is not present in the organization, and in that moment you have to change the definition of the risk, and after that this is not going to be shown as a risk or appreciated as a risk, or you remove the authorization from the user if the authorizations are not needed or not used, or the activities can be given to another user. And the other and last and most preferred possibility, because in short term it's also the possibility with these additional efforts, is to mitigate. What I mean with mitigate is that you acknowledge that there is the risk and you assign a compensating control, a compensating measure, which is regularly done, and this compensating measure mitigates the risk. And although it's there, it's not, it's under control. But as I mentioned earlier, it's a trade-off. And in most organizations and in some process setup, the user has to have the ability to get his job done, even though it means that there is some risk present. And this risk, even when addressed by a compensating control, is typically not addressed in an efficient or automated way, and causes more overhead, causes additional costs. And a way how to address this in a more effective and more automated way is introducing automated controls. And I would like to show you just one example of such a control. And in this particular case, the user is able to change a billing document and change a sales order. And the compensating control would look only at the risk itself, which is that the user executes a changed billing document or changes the billing document for a specific customer. And for the same customer, he also changes a sales order. And in this particular case, the control would show this to the responsible person, and this responsible person would review it. This is an effective way how to tackle such a risk, whereas if it would be a manual control, you would have to have a look on the complete list of such billing documents changed and a complete list of changed sales orders, and you will have to compare these and elaborate which one might be a risk and then analyze these. And with that, I would like to hand over to Dan French.
Thanks, Jan. That was very interesting. I definitely echo the sentiment of these reports, these big reports, and you're supposed to sign them off, and you've got to go through 10 pages of a report. I mean, the reality is, most people are too busy to go through the detail. So even when the reports are provided, if they're very generic, they get signed off without really any sense of detail and look at the risk. So thanks, Jan. So your internal controls expertise has certainly helped this client out, and there's some very interesting experiences there, not least the scale of the organisation. What I want to, well, before I go to this piece, I also want to just remind you that Jan referred to a number of best practice documents that go associated with this kind of program. And if you're interested in those, they're to do with the compliance tool audit, risk-based remediation, and a couple of others, which right now elude me. But if you want access to those, just drop us an email or contact Arena and we can get them to you. So the interesting thing about the whole SID issue, in fact there's a couple of interesting things, is there are, for what is a very obvious accounting principle, because segregation duties existed as an accounting principle long before ERP systems. It's a very common sense principle, but separation of activities. But in practice, it seems that there is a number of issues that emerge when you get into the detail of these things. I'm sure many of you have, where you start trying to address one issue and you pull this string in the Gordian knot, and instead of loosening it up, the whole thing tightens and gets worse. So I like this this kind of mythological Gordian knot, because it's, particularly in SOD, it seems like a very classic problem. So some of the things that I see on working on some of these, participating in steering committees and advising organizations, SOD starts as a business issue because it is an accounting business issue, but because of complexity and association with IT systems, and because IT systems are very nitty-gritty down, and when it gets down to this stuff, it starts becoming an IT problem. And if you're not very, very careful, these initiatives die a very sad and lonely death in IT, because the finance management lose interest. What was something started to be a good idea and a good method of risk management, in the end gets so detailed and specific around technical, arcane details they really don't want to know about. It becomes a big, big problem. So one of the big questions, I think is relevant to all of these, is how do we ensure that SOD remains a business control rather than technological control? Now clearly, it is an IT control when it relates to internal IT people doing stuff with the system, but in the main, it's about people performing, revenue and expense and general accounting issues. So how do we make sure that happens, and make sure we don't make it so complex that the business people say, look, you better look after this yourself? I think, so that's the biggest, very, very big issue. I think the other elements, the fourth point here, the business realities. I mean, one of the reasons I think that business leaders get very frustrated with all the SOD activity, and particularly because it's, as we said at the beginning, it's probably the most common and popular activity in GRC, is SODs are very blunt instruments. I mean, if you consider the create vendor, pay a vendor, there's actually no risk at all that I have the access to create vendors and pay vendors. There's only a risk when I have the ability to create a vendor and pay the same vendor. So these very rough cut controls, I think, also creates concerns. But the other business realities is with more control and compliance focus in large organizations, in many businesses I see, it's taking much longer to provision new user IDs for new people in the accounting, in the shared services units, for example. And now what you see is people sharing user IDs while they wait for their new compliant user ID, which destroys the whole argument of having SOD at all. The other issue, classic issue, is generally speaking, SOD programs don't really deal with the manager-assistant segregation. I mean, if I say to my assistant, I'd like you to approve this purchase order or approve this payment, they're not really going to say no. So there's a lot of business realities which make this a softer and less robust control than we might like it to be. Jan talked very clearly about the issue of compensating controls, which is, you need compensating or mitigating controls for certain areas where you've got one person in the accounting office in Azerbaijan, have to do everything. But obviously then you've got to be able to make sure you do validate the real risk when they actually occur. And then there's some kind of technological issues, in multiple systems. When you're doing SOD, spanning multiple systems, which we do quite a lot of, there's a lot of subtleties, like people using the same user IDs across them and all that stuff. And then this whole issue about SOD matrix, you may have many, many systems. And those systems may be slightly different versions or variants of different applications, and then you have to manage this change across the SOD matrix. So a lot of challenges there, but that's primarily kind of just almost an administrative problem. But I think the big deal is, and what I hear a lot from finance executives, is how do we balance the whole risk and control thing and still drive the performance we need in our finance function? Because there's a lot of pressure to drive down the cost of finance and not put more and more effort into these things. And the concern is that a lot of the time, this SOD stuff really looks like control looking for a problem rather than a genuine risk-based approach. Now, I think if you look at the risk and control balance, any of you who've seen me present before know that I can't go through 45 minutes without showing this slide. This is a lovely little image of a car park in winter, and in the middle, if you look very carefully, there's a car park barrier, and that car park barrier is a control for the company to make sure only people who are authorized to come into the car park in the facility actually come in. So you swipe the pass, okay, so as you come in, it opens up, records you're in there, and on the way out, you do the same thing. It knows you've left and no longer the responsibility of the company facilities manager. So that's all very good, and every 3 months somebody comes along and checks the control, the barrier. But then in winter, this was a photographs taken in some amusement about how poor this control worked. But it really highlights the issue, the difference between risk and control. There was a danger. We spend far too much time worrying about the car park barrier than we do worrying about the tyre tracks. And yes, the car park barrier is good to have, but we can't just assume the car park barrier is stopping everything. We have to understand tyre tracks. And when you think about that in business processes, you've got to think about that carefully. Otherwise, we put an inordinate amount of effort into securing the front door of our business and basically leave the back door and the windows wide open, which is completely pointless. So there's this whole point about how to get the balance between the control and the tyre tracks, which is really the risks. So what we're seeing, obviously, is when you look at the issue of monitoring risk and monitoring controls, what we're seeing more and more is that these exceptions, these tyre tracks, which are basically the difference between what's supposed to happen and what really does happen in our business processes, these really represent genuine risks and genuine performance impact, and usually they represent both. And if you can get into this discussion with your finance process owners, it's an interesting discussion because they're very focused on improving performance. So if they can monitor for the risk and also improve performance, they get much more interested, and it's much easier to get the stakeholder buy-in. So it's worth thinking about. I mean, the other part of the problem when we're thinking about our controls and risks as they relate to our big systems that run our accounting business processes is, we're all working in organizations that have invested heavily in common systems to drive, process standardization across the organization to help give us, business efficiency and economies of scale, and also give us scalability so we can start up, new operations without too much trouble. Well, that's all very good. But there is an assumption that these systems actually automate a business process. But actually they don't. What administrative systems, ERP systems, accounting systems, all of these systems, CRM systems, all they do is they create a standard data input process. And it's very important to separate the two because it helps us understand risk and control. So let me just give you an example. So we know that we can set our financial system up to make sure that I cannot post a goods receipt or I cannot post an invoice receipt if I don't have a purchase order. So that's easy to implement. So it's easy to assume, therefore, my whole three-way match process is working fine and my three-way match risk is working fine. But consider this example, which is far more common than I guess we'd all like. So some delivery happens, a truck delivers a shipment or an invoice turns up in the finance department or the IT department, and no purchase order exists. But people say, okay, well, we need this, whatever. So they speak to purchasing, can you create purchase order for this? So it gets purchase order, appropriate approvals. So once the purchase order is created, then the person that's received the invoice or the delivery can then post that and say, right, created that. Now, the system is perfectly happy that everything's happened in the right sequence. But as a business process, and from a risk point of view, it's horrible. It's absolutely horrible. So we've got to remember that we get too tied up in the idea of SOD. Many of the times we're missing the risk. Here, there's segregation of duties between the person receiving goods and the person creating purchase orders and approving purchase orders. But fundamentally, the risk is wide open. And we see this in a lot of organizations, and there's a big, there's a big surprise when we see this. And there can't be, we've implemented this great new system at great expense. So it's very important to consider this when thinking about your risk and controls matrix for the work you do. So in terms of balancing our risk, for stuff that matters, key risks if you like, yes, we need to monitor and prevent high-risk segregation duties issues. We need to do that. But as we know, that's not enough. We also need to monitor any embedded system controls where they exist, which might be the three-way match, if you like, the process control. It might be that we need to also monitor related master data for sensitive changes if that affects this risk. And we monitor the specific business transactions, which may fall outside accepted boundaries. If we do all four of those, then we've got a 360-degree kind of risk and control visibility, which really helps, and it also helps us focus on what's important. So rather than spending, as I see some organizations spend 2 or 3 years doing an SOD program, and they're still wide open everywhere else, spend a little bit less time, but cover the key risks in all these dimensions. And that's definitely one of the lessons that's coming out as we work with these kind of organizations. So there's an example. Access risks, configuration risks, process risks, transaction, master data, and IT general risks. So when you focus on the key risks and then worry about what needs to be monitored to validate that. And that's a much healthier approach. And then management can actually feel some level of confidence they've got it covered. So what have we learned down this path? We're seeing that we need to balance these 4 pillars of CCM, or continuous monitoring, we call it. We need to balance looking at the configuration system. We need to balance the SOD thing. We need to balance that with looking at sensitive changes to master data and transactions that fall outside expected norms. If we do that, we're in a much better shape, not just to manage risk better, but also to get the buy-in from the stakeholders, particularly in finance, purchasing, sales operations, and the rest, because it's dealing with real business activities and real business risk, managing performance. So, that's pretty important. I think it helps you bring stakeholders on the journey. All the evidence is, as with all changes, you want to start small across all 4 pillars and move down, which is a smart move. If you've already done SOD, again, just start small, but on the remaining 3 pillars, but do them together. Don't try and do them in a sequential linear way. Very important not to make assumptions. A number of times that you hear that, oh, we don't need to check this because we've got a workflow system that stops that, and we've got these controls embedded. And the answer always is, that's great, but let's not assume anything. Let's monitor for it anyway. And invariably, you see those issues still exist. And people say, how can that happen? And then when you look into it, you realize there's more ways of going through a process than people who implemented the controls realized. So consider performance as well as risk, and remember this. Basically, start small. Iterative refinement is all about less is more. So avoid the temptation of monitoring too much. If you focus on the key risks, you'll be in good shape. Some of the challenges are that although that photograph of the tire tracks is very memorable and compelling, in reality, when you apply that to your business, there's a gradual realization, and it takes a while to get the aha moments. Also very important to not see this as an audit activity, it's a management tool. Management own the control system, the risk management, and it's their goal. And it's about data, but it's not an IT task. Make sure it's owned by the business. And you will learn, or they will learn, some new things about their business they didn't know. So, final question for you. Why do you think SOD gets so much attention? Given what we've described, and there's a lot of weaknesses, and should it get all that attention? Why? Is there a more balanced approach? I'm not even going to answer that question because I think you probably all know the answer, but if you don't, ping me an email and I'll give you chapter and verse. But a very interesting comment came from a CFO we worked with recently, and he was doing some monitoring across his financial processes on the revenue cycle and expense cycle, transactions and data for the key things he cared about to identify performance gaps and also risks. And what he said at the end of doing this process, which was pretty rapid, he said, wouldn't it make more sense to do this first? And when I see the risks in reality coming out of my business, I use that to determine where to focus my effort on implementing controls, rather than do what the classic advice is, implement controls across the piece for 2 or 3 years, and then worry about it. And I think that's a very, very sharp observation. I think we're going to see more of that. So I think that's worth thinking through. Finally, whatever you do, whether it's just straight SOD, whether it's doing all 4 layers of the continuous monitoring model, just remember the rule of all programs. Be very clear and focus on what you're trying to achieve. I'm sure you've seen this little cartoon before. It makes me laugh, so I'll put it there. You start off with what you think, what was explained, all the way through that interesting little dynamic to end up with something completely different, which is hopeless. So make sure you don't do that. So finally, we've got a couple of minutes left. So we have some questions. some of you have put some questions into the panel. Don't think I'm going to be able to do them all, but a couple of obvious questions. Can I get a copy of the presentation? Yes. Send an email to Arena. The other one is, can I get a copy of the best practice documents? Yes. Likewise, I'll show you the email addresses in a minute. There's a question, somebody basically asked my question back to me. The SOD user access are not a major risk. Why do companies spend so much time on it? Well, I'm going to leave that one for you because I want you to think about that this afternoon. And then if you still want to talk about it, send us an email tomorrow. Nice one here. Does continuous monitoring include process controls? Now, I think by that you mean monitoring the embedded process configurations in systems. So hopefully, as you've seen with these 4 levels of monitoring, process control is one of them. It is monitoring the embedded process configuration that makes sure you can only post a goods receipt on the other purchase order. That your tolerance for payments is 5%. All those kind of things, all those classic controls. Now, yes, it's good to monitor them, but that is a bit like the car part area. So it's also very, very important to, as well as monitor process controls, you want to monitor the master data for sensitive exceptions, sensitive changes, and monitor transactions that fall outside the boundary, even if you believe that your process control should stop that happening, because invariably they're not, they don't catch everything, and that will give you the full, that will give you a much better coverage. I am conscious of time. We can't answer the rest right now. Apologies for that, but we will respond to other questions by email. I'd like to thank you for joining us. Hopefully you got a sense of where the evolution of GRC is going, particularly in the continuous monitoring area. If you want to ask any questions, if you want to have the best practice documents, if you have other questions you haven't thought about asking, we want to make sure we get them. That's Jan and my email addresses, or you can contact Irina directly, who organised this. So thank you very much, Irina, for organising it. And there's also a blog there which has the occasional ramble on topics such as this, based on the experiences we see out in the real world. So thank you very much for joining us. That's our 45 minutes. I wish you the best for the rest of the day, and speak to you soon.